Hello and welcome back to my channel. I'm Sarah Edens and I'm so happy you chose to join me today. We're talking about February market updates, financial news, and everything you need to know that's important going into the month. So let's look at the top 3 things that are kind of key to watch throughout the month of February. The first one is this incredible stock market rally that we're watching with the S&P 500, the Dow Jones, and the NASDAQ all closing at record highs every single day lately, other than Monday, which was, of course, in reaction to the Federal Reserve's meeting where Chair Jerome Powell announced that they were not actually going to be doing interest rate cuts in March as everyone has expected. And so a lot of the uptick in the stock market that we've seen had been pricing in the expectation, which had been kind of telegraphed by the Federal Reserve in some of their other meetings that they'd had and announcements that they'd put out. But that was not to be. And so we are not getting a mortgage interest rate cut or interest rate cut in March. And so that's where the markets kind of took a bit of a downtick just in reaction to that. But in general, we've just seen these incredible all-time highs in the stock market. So what's on my mind as I watch this is, will it last? How long will it last? Obviously, nothing lasts forever. So it's a normal market cycle. Well, this is kind of an abnormal market cycle that we're in right now. The markets are behaving in a way that Greg Jensen, who's the co-chief investment officer of Bridgewater, calls atypical. So the markets continue to behave in this atypical way with just these massive gains that they've made. And so we'll look at, do we think this is going to last and what is going on here? So one thing that's very interesting to look at is that while there are lots of people in the stock market right now and lots more piling in as prices are performing, stocks are performing so well, there's a lot of investors who are sitting in cash and sort of waiting this out on the sidelines. And when I say cash, what we're looking at is the cash kind of equivalent in the investor world, which is money market mutual funds or money market funds. This is not the same as a money market account. So you might have heard about a money market account from your bank. That is FDIC insured and up to $250,000 per depositor. And that is not an investment vehicle. A money market fund is a different type of thing that's on the stock market. It's an investment vehicle, but it's a relatively safe one as investment options go. So you're basically investing in things like cash. It's just over on the stock market instead of in your bank account. And so that's a very interesting thing that we're watching right now, is that there's just an absolute record amount of cash sitting in money market mutual funds. So it's actually right around $6 trillion at the moment. And it's like, why are people choosing to sit in cash when they could put their money in the markets and be getting these incredible returns? Well, some of it is that some investors are wary that there may be a recession here in the next 12 to 18 months, like what I've talked about here on my channel. And I will link to all of my recession watch videos and my playlist down below so you can watch that. The other thing too is that lately the money market fund accounts have been offering a 5% rate of return in this inflationary cycle that we're in. And so that has actually been something that's been a pretty good deal, to be able to get 5% back on those kind of investments. It's a relatively safe investment. You can have it in your portfolio. It's low risk, but you're getting 5% back. So that's one reason why a lot of people have piled into those money market mutual funds. But it's also very interesting because the Bank of American Global Research reported on Monday, quote, "Record high cash levels suggest that investors do not believe in the early 2024 all-time highs on the SPX," technical strategist Steven Settlemyer wrote in a Monday note. But high cash levels also suggest dry powder for buying tactical dips in a bullish backdrop. So that is kind of looking at, okay, maybe a lot of these investors are keeping their money in these money market funds because they're just waiting to jump on those opportunities should the market go through a big correction like the one that we're looking at over the next 12 to 18 months that many economists are predicting. And so that's something that we will just have to see what unfolds there. But that's going to be very interesting to watch. And it's just a very fascinating thing how many people are choosing to leave their money in those relatively safe investments rather than pile into the stock market. I think it tells you a lot about investors' kind of overall pessimism about this rally that we're going through right now and these stock market highs, that they're really hedging their bets in cash. They're in their money market mutual funds. So that's just something that I'm keeping an eye on that I thought was kind of another indicator in my mind that despite the economy doing well here in the US, the jobs reports being fantastic, there's just a lot of people that are choosing to kind of have this wait and see approach. So I'm watching that as well. The second thing here for February is that the tech sector is continuing their layoffs despite booming job numbers. Why is that, you might ask? So many other people are asking the same question right now, and it's not just the tech sector. Unfortunately, companies even like UPS and other corporations have announced that they're going to be going through big layoffs here in the next couple of months as well. But in the tech sector alone, in big companies like Amazon and Google and these big tech giants, they actually laid off 360,000 workers over the past 12 months, so in 2023. And then in 2024, so far in January, they've laid off 32,000 workers in January alone across Google, Amazon, Microsoft, Discord, eBay, places like that. And so it's really leaving people confused because they're like, well, the jobs numbers are supposed to be the best they've ever been or the best they've been in quite some time. We're seeing this super great jobs growth. So why on earth are we like having the companies laying people off at the same time? And that's just where I think in many ways it gets back to corporations really focusing on their bottom line. Some of them are still blaming the overhiring that they did during the pandemic and that they're like, well, we overhired and so now we're letting go of some of those hires that we brought on during that time. Others are pointing to just wanting to get better returns for their investors. That was something that the chief financial officer at Amazon, Brian Olszewski, said during a media call last week. He said, quote, "We're going to continue to be careful on what we invest in, and we're going to continue to invest in new things and new areas and things that resonate with customers. And where we can find efficiencies and do more with less, we're going to do that as well," he said. So that kind of means two things. That means if you're working in the tech sector currently and you're watching this video, now might be the time to dust off your resume if it's been a while. I read a really interesting interview that one of the media groups did with tech sector workers who had been laid off over the past couple of years. And they said the tech world has just changed so much and not for the better when it comes to the employees, because it used to be a great industry to work in. You used to have great perks and great benefits, and they really took care of their employees and their human capital. But now they are just not prioritizing that the same way as they did pre-pandemic for a whole host of reasons. And so they said it's just tough because the tech sector for so long has been pretty layoff proof. But since 2020, that just hasn't been the case. And we're seeing that now, here we are going on year 4 of pretty consistent and steady layoffs in the tech sector and other sectors as well. So it's just something to really pay attention to of if you are in that industry to always be prepared if you had to go job hunting again, have your resume sorted out and have your referrals sorted out that you might need, really start boosting your LinkedIn presence and your professional networking and things like that. And then the other thing that you really want to focus on is, can you bring in other income streams from other industries? Is your spouse also working in tech, or is your spouse working in another industry, or your partner? Do you have a way to have like a side job in a different industry, or have an entrepreneurial side gig that you do where you're working for yourself? And so that it's not going to be such a shock if you do suddenly get let go, because a lot of these companies aren't really communicating these layoffs ahead of time. It's just very, very sudden for these employees. And so it just causes a real headache and stress for people that maybe have worked at Amazon and Google and these companies for many years, even decades, and they're just getting let go because the corporations are prioritizing their bottom line. I did see a really interesting interview too, where they talked about why are the CEOs not, in general, some of them are, but in general, why are the CEOs not willing to take a pay cut to be able to keep more workers on? Because these CEOs are getting paid these enormous compensation packages, tens of millions, sometimes hundreds of millions of dollars. And so people are like, well, why are you paying your CEOs so much? And then you're laying off all these people. And what I saw in this one article that they were talking about is that the CEOs don't get paid in cash or the way you would expect a paycheck to come in as their whole entire salary, that they get paid in stock options. And so it wouldn't really make that big of a difference if they gave them like a pay cut because they're being paid in Amazon stock or Google stock options or something like that. So that was one argument that I saw for why the CEOs won't take pay cuts. However, I have seen other CEOs who absolutely do take a pay cut and say, hey, I would rather make less right now during this time, and we'll retain more of our workers and our talent and our human capital, and let's stay invested in those people. But that's just very rare. In most industries, most of them will keep paying their CEOs big bucks and then lay a lot of people off. And then unfortunately, then what happens is that they will just expect the people who remain to work harder and harder. That was something that I saw in Amazon's chief financial officer's statement, where he kind of implied, where we can find efficiencies and do more with less, we're going to do that as well. Well, doing more with less workers mean that the workers who are there left behind are probably still a little worried about getting laid off. And on top of that, they are having to work harder and they're having to work longer hours, and there's more demands and expectations on them because the people who used to be on their team are not there anymore, but the companies still want the same output. So long term, I don't think this is going to be sustainable for the tech companies or any companies that want to cut. At some point, they're going to either burn their workers out or really sacrifice productivity. But unfortunately, this is just something that's kind of inherent to capitalism and the capitalistic model that we live in here in the United States and in most of the Western world, where companies prioritize their bottom line, their income, their returns to their investors, rather than prioritizing their people. I don't love that system, but that's just the one that we're in. So anyway, if you are in tech, pay attention, because this might be the time to start bringing in multiple income streams. Keep your feelers out for other options and stay really well networked in case, and keep your ear to the ground too if there's any kind of rumbling of thunder at your company. You don't want to have it be completely catching you by surprise if at all possible. So that's going on in the tech sector layoffs, and others, like I said, UPS has announced that they're going to be doing more layoffs as well. Then the third thing that I found very interesting as I was looking kind of across all the articles that come across my desk every single week on my Google News feed about financial topics, market topics, and all the things I keep track of throughout the month for you, so I can keep you informed of the things you need to pay attention to, is something that you'll have observed as well, which is in general, prices are still not coming down. And again, it's like, what gives? Why haven't prices come down more? Whether we're talking home prices, which are just at astronomical all-time highs, rent is at astronomical all-time highs. If I can find it, I'll put a chart on screen that shows where we are with inflation in terms of categories that are really struggling, where we're really noticing very high prices on these different categories versus the ones that maybe haven't been affected so much by this inflationary cycle that we've been in. But anyway, we've seen prices just stay really elevated ever since 2020, and we haven't seen prices settle or normalize back down to what they were in, say, the end of 2019, whether that's groceries and, like I said, housing, rent, things like that. Cars, auto prices are just crazy. So you might be wondering, well, why is that? And is there any hope on the horizon? So I did some research on that. Obviously we're all feeling it because that's where the majority of our paychecks go, is to places like housing and places like food and places like gas to, get to work and back and things like that. Medical bills haven't come back down either. Healthcare premiums are crazy. So we're just being squeezed from a lot of different directions right now. And it just makes it very uncomfortable and very unpleasant, doesn't it? It's not a fun time, especially because when we talk about, oh, back in the good old days, everything used to be so much more affordable. And, usually you hear people talk about that when it was 30 years ago, and we're talking 4 years ago, back in 2019, barely 4 years ago. And so it's just kind of disheartening to have seen the prices just drastically rise like that. And then our incomes obviously not keep pace with that. So when I was doing some research on that, I found a really interesting piece that Vox wrote up that I'll link to down here in the description. They said on the consumer end, once companies increase the price for, say, shampoo or soda, they don't often revise them back down. Corporations have been quite open that people are largely hanging with them on price increases over the past couple of years, which has allowed them to hike even more. There isn't much consumers can do about it. Now, I would argue there is things consumers can do about it in the sense that we do have the ability to stop buying things if they get ridiculously overpriced. So, if a product raises its prices too much, I think especially right now, they probably do risk losing customers. But it's true that, if you have a certain product that you're really devoted to purchasing, and like I have this certain brand of eggs that I really like buying just because they're like really healthy and really nutritious, and they just remind me the most of like farm eggs, of the ones that you get at the farmer's market. And I just love them. They're so tasty, but the prices on those just keep going up and up. And every time I buy them, I'm like, oh, like that's really kind of painful, but I really like these eggs. So I guess I'll just keep buying them. So sometimes you have like those products that you love or those items that you love that you're just like, oh, well, that's life. So while prices might not keep shooting up at the record pace that they did over the past 3 years, like Vox said, we're probably not going to see them settle back down at any time in the near future. What Vox was saying in their article later on was that basically what consumers are talking about when they're like, wouldn't it be nice if we could have lower prices, is if we basically went into, rather than this inflationary cycle that we're in right now where prices keep going up, that we would go into a deflationary cycle where prices go down. Well, the problem with deflationary cycles is that often that's what kicks off recessions, and then the economy has problems and people are getting laid off and prices might be low, but nobody has a job, so they don't have any money to buy the items in the first place. That was what we saw during the Great Depression. And that was something that I remember reading. There's a very interesting book that I'll link to as well in the description called The Great Depression, a Diary. And it's about this, it's just this attorney who kept a diary during the Great Depression that his family later published. And he talks about that, where he's like, there's all these people and nobody has jobs, and like you can get homes for nothing and you can get cars for nothing and everything's so cheap, but nobody has any money. So it doesn't even help because, and he goes on a lot about that, where he's like, gosh, if I had some money, I could pick up like all these apartment complexes and make so much money renting them out, but I don't even have any money right now. And he was really bitter about that, understandably so. So it's sort of a double-edged sword where it's like, yes, we would love to see the lower prices, but no, we don't want a recession either, even though it's definitely something that many economists are predicting, and it does tend to lead to lower prices. Like, we don't really want that either, right? That has its own problems. So that's just kind of where we may just kind of have to try to adjust as much as possible to these new prices, even though they're painful and miserable and they don't feel fair. Vox had a really interesting point that they made too. And it said, because there's been so much in the news about, oh, the jobs numbers are so great, or, oh, the GDP growth has been so great. And Vox was like, this was another thing from their article. They said, overall, people do just seem angrier at inflation than they are happy about jobs. A recent Blueprint/YouGov poll found that 64% of registered voters would most like to see lower prices on goods, services, and gas improved in the economy, compared to 20% who wanted higher wages, 9% who wanted lower interest rates, and just 7% who wanted more jobs. And so that's where, obviously the things that we want the most are the things that affect us the most. And so if we're being most affected by high cost of living, we want the cost of living to come down, and that's the thing that we're most affected by. And so that's kind of what's number one on our wish list. And so that may not happen for us anytime in the near future. And so then it's just really all about getting your budgeting strategy down so that you can just say, okay, fine, this is the new prices of everything from groceries to gas to housing to cars. And it is a little bit more challenging, or perhaps a lot more challenging, depending on your situation. I think that the only way to really overcome that, well, there's two ways. One is that you can really get your budget streamlined and really keep cutting your expenses aggressively and stay on budget really, really aggressively and keep everything in line that way. The other thing that you can do is just figure out how to bring in more income streams for yourself and your family. So that's another thing to also think about is, are there ways that you can bring more money into your household every month? I know that's easier said than done. I've got some videos on that I'll link to in the description if you want some ideas to get you started. But that's another way to overcome higher prices, is figure out how to bring in more money to your household. So again, you can like cut your expenses, or you can bring in more money, or you can do both. So it's really just up to you. But those are the three things that I'm watching right now: this big stock market rally that we're in right now, and then the high prices on everything that we're watching, and then as well these layoffs predominantly in the tech sector, but in other companies as well that are just ongoing, unfortunately, through 2024. And so if you're being affected by those, just really keep your ear to the ground at your company and kind of stay mentally prepared for perhaps having to be affected by that. I hope you're not, but it's just a really important thing to keep an eye on, since it's been in the news a lot and it's been affecting a lot of people, unfortunately, so far this year. All right, well, that's everything I have for you today for February money news updates. Thank you so much for joining me, and I will see you again soon in my next video.